Geopolitical risk and market impact. Sector-by-sector analysis in brief. Geopolitical tensions, from wars in Ukraine and the Middle East to broader superpower rivalries, are roiling markets. Certain sectors thrive on conflict: defense contractors, cybersecurity firms, oil producers, while others suffer: airlines, tourism, regional banks. Below is a comprehensive podcast-style script breaking down 6 key sectors: defense, cybersecurity, energy, airlines, tourism, and regional banking, with bull versus bear cases for each, time frames for impact, likely catalysts, and specific stock examples. 3 tickers bullish, 3 bearish per sector. A visual risk heat map thumbnail is also provided for a quick overview of sector risk versus bullish bias. Let's dive in. Hello and welcome to your podcast name, where we decode how global events drive market moves. Today's episode is a long-form deep dive into how geopolitical risk, think wars, conflicts, and international crises, affects different stock market sectors. Our focus: 6 sectors on everyone's radar right now, given the turmoil in Eastern Europe and the Middle East: defense, weapons and aerospace, cybersecurity, energy, oil and gas, airlines, air travel, tourism, travel and leisure. Regional banking. For each sector, we'll explore potential price increases versus decreases, the time frame of impact, immediate shock versus longer-term trends, and key catalysts that could move stocks. We'll highlight bull case tickers, stocks that could rise if things go a certain way, and bear case tickers, stocks that could fall under adverse scenarios. You'll hear specific examples: 3 bullish and 3 bearish picks per sector, along with recent market data and even options trading insights to illustrate how investors are positioning. By the end, you should have a clear picture of where opportunities and risks lie under today's geopolitical cloud. Big picture: geopolitical flare-ups create winners and losers in the market. For instance, it's virtually a cliché that defense stocks jump when wars erupt, while travel and tourism stocks tank in the face of conflict. We've seen this pattern recently. Defense stocks have benefited from increased military activity in the Middle East and Ukraine, notes U.S. News. In late 2023, as war fears rose, drone maker AeroVironment, AVV, surged 30%, and parts supplier Transdig, T2G, jumped 32% in about 6 months, handily outpacing the S&P 500. At the same time, the NYSE Arca airline index plummeted 33% over roughly 3 months, and travel companies felt real pain. E.g., Marriott Vacations Worldwide, VC, fell 30%, and Norwegian Cruise Line, NCLH, 19% in the half year after new conflicts began. Money.usnews.com, CNBC.com. We'll unpack why these moves happen and what could happen next. So whether you're a trader trying to play the swings or an investor seeking to manage risk, stay tuned. Let's start with the sector that's front and center whenever bullets fly. Defense sector, aerospace and defense contractors. Overview. The defense sector tends to be inversely correlated to peace. When geopolitical conflict escalates, defense stocks usually rise, sometimes dramatically, as governments ramp up military spending and investors flock to safe revenue streams from defense contracts. Conversely, signs of peace or budget cuts can dent the sector. Overall, the bias is bullish in conflict scenarios. In our risk matrix, defense had a high bullish bias and low bearish bias, with overall risk labeled medium. Risks are moderate, because even in peacetime, defense budgets in many countries are structurally higher post-conflict. CNBC.com. CNBC.com. Bull case. Conflict escalation or prolongation. If wars drag on or expand, expect defense contractors to keep rallying. Major catalysts include increased defense budgets, new weapons contracts, arms aid packages, or additional countries getting drawn into conflict. For example, since Russia's invasion of Ukraine, 2022, Western nations have boosted defense spending, benefiting arms makers. Lockheed Martin, LMT, the world's largest defense contractor, profits heavily from war-driven demand, e.g., Javelin anti-tank missiles, HIMARS rocket systems. Northrop Grumman, NOC, and General Dynamics, GD, likewise see revenue windfalls from procurement of missiles, drones, tanks, and aircraft. In Europe, names like Rheinmetall literally went from obscurity to multi-bagger gains. Rheinmetall stock is up over 2,500% in 5 years since before the Ukraine war, illustrating the scale of a defense boom in wartime. 4 U.S. defense giants. Even if the stock moves haven't been that extreme, they've been substantial. Example: after Hamas surprise attack on Israel in October 2023, RTX Corporation, RTX, formerly Raytheon, hit record highs in 2025 on strong military demand, at one point up 50% year-to-date. Textron, TXT, jumped 7% in the months following that conflict. Options activity often confirms this bullish sentiment. We saw call option volume double on LMT and triple on RTX during defense sector rallies, reflecting traders betting on further upside. Defense contractors also typically have backlogs stretching years ahead. BAE Systems boasts a record $100+ billion backlog, so a conflict can create a multi-year revenue pipeline, not just a brief spike. Nasdaq.com, Schaeffer's, Search.com, Money.usnews.com, Nasdaq.com, timeframe. Immediately after a conflict event, defense stocks spike within hours or days. Investors rapidly price in higher arms demand. This initial jump can be followed by a sustained uptrend if the conflict proves protracted, as budgets and contracts flow over months and quarters. However, if the conflict is short-lived or contained, the gains might level off once the initial panic bid fades. Generally, as long as a geopolitical threat looms, defense stocks enjoy a structural tailwind. Think in terms of a medium to long-term bull trend lasting as long as tensions persist. As Invesco's strategist Ben Gutteridge observed, even anticipation of a prolonged period of geopolitical tension can make defense a structural position in portfolios, not just a trade. CNBC.com, bullish tickers by /list. Top 3 picks likely to rise with geopolitical conflict. Lockheed Martin, LMT, a bellwether defense stock, makes fighter jets, F-35, missiles, defense systems. Bull case: further conflict escalation, Europe, Middle East, or elsewhere, means more orders for Lockheed's hardware. LMT has historically been a prime beneficiary of wartime spending. It's been said no company profits more from war on Earth. Key stat: Lockheed stock climbed sharply after major conflicts. It hit all-time highs in 2022 after Ukraine war began. Options traders often pile into calls on LMT during crises. Time frame: jumps on immediate news, e.g., up within days of an invasion, and longer-term uptrend as budgets translate to earnings over 1 to 2 years. Schaeffer's, Search.com, Northrop Grumman, NOC major contractor, stealth bombers, nuclear missiles, drones. Bull case: provides advanced systems crucial in a high-tech conflict. For instance, demand for its global Hawk surveillance drones and B-21 Raider stealth bomber program could surge if global tensions remain high. NOC hit a record high in October 2025 amid strong orders and was plus 27% YOY at that time, far outperforming the broader market. Time frame: similar to LMT, immediate sensitivity to war news, plus multi-year gains if defense budgets stay elevated. Schaeffer's, Search.com, General Dynamics, GD diversified defense, tanks, warships, submarines, Gulfstream jets. Bull case: as the maker of the Abrams tank and Virginia-class submarines, GD benefits from both land and naval arms demand. It's also a play on NATO's renewed focus on heavy armor, tanks for Eastern Europe, and naval readiness. If conflict triggers a naval arms race or expansion of U.S. Navy shipbuilding, GD's Marine Systems segment wins big. Time frame: somewhat slower moving. Shipbuilding contracts play out over years, but significant uptrend potential as orders accumulate. GD's steady dividend and lower volatility may also attract long-term investors during conflict. Bear case: de-escalation or defense downturn, what could cause defense stocks to drop? Primarily, peace breakthroughs, ceasefires, or budget cuts. If a major war ends sooner than expected, the fear premium in defense names could deflate. We saw a glimpse of this on November 24, 2025, News of potential Ukraine peace talks caused European defense stocks to tumble 2.5% in a day. Rheinmetall, Saab, and others fell sharply on hopes of a peace plan. U.S. defense names also pulled back on that news. Morningstar's defense analyst noted that the market's reaction to peace prospects might be overstated, but it's certainly real. Another bearish catalyst, government budget tightening, e.g., if the U.S. or EU, grappling with deficits, decide to cut defense procurement or hit contractors with price negotiations. Also, political shifts, like a dovish administration less inclined to spend on military, could slow orders. Short-term time frame, peace headlines, or a surprise diplomatic deal can hit defense stocks overnight. Longer term, if a war concludes, defense stocks could lag for a while, especially those that ran up the most during the conflict. For instance, after the first Gulf War in 1991 ended, defense budgets shrank, and many contractor stocks stagnated through much of the 1990s. The post-Cold War peace dividend. CNBC.com. 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 Bearish tickers. Avoid/short. 3 examples likely to fall or underperform when geopolitical risk abates or if the defense outlook sours. RTX Corporation. RTX wait. Wasn't RTX also a bull? Indeed, Raytheon/RTX soared with conflict, as noted, plus 50% YTD in 2025 at one point. But that means it also carries downside risk if peace breaks out. RTX has a dual exposure. Half its business is defense, missiles, radars, but half is commercial aerospace, Pratt and Whitney jet engines for airlines. In a peace scenario, defense order flow might slow, and moreover RTX's commercial divisions could face headwinds if prior conflicts led to global economic softness. In late 2025, when peace talks gained traction, RTX stock cooled off from highs. Bear thesis. After a big run-up, any hint of reduced threat could spur profit-taking. Notably, RTX also had an unrelated issue, a massive jet engine recall in 2023, showing that company-specific problems can compound the downside during calmer geopolitical periods. Schaefer's, Search.com. Boeing, BA Boeing is a bit of an odd one. It's a major defense contractor and a commercial plane maker. But if we anticipate a peaceful stretch, Boeing's defense segment might slow. Fewer urgent orders for fighters or tankers, while its commercial segment could still be at risk from any lingering economic damage or high oil prices that wars left behind. Boeing has also struggled with execution, 787 and 737 MAX issues, making it vulnerable if investor sentiment shifts away from war stocks. Bear case. In a world without new conflicts, Boeing's valuation might lean on shaky commercial recovery rather than defense strength. So if anything goes awry, technical problems, etc., the stock could falter. Additionally, Boeing's defense margins have been under pressure. A period of lower defense outlays could hurt profitability further. L3Harris Technologies. LHX L3Harris is a mid-tier defense electronics and communications firm. It boomed during conflict, providing tactical radios, avionics, etc., but it has had execution hiccups, e.g., cost overruns on military satellite programs and integration challenges for past mergers. Bear thesis. If defense budgets plateau or fall, LHX could underperform larger peers. It's less diversified and recently took on debt to acquire Aerojet Rocketdyne. In a peace scenario, investors might rotate to safer defense plays or completely out of the sector, leaving LHX punished disproportionately. Indeed, LHX stock lagged in 2023, down 18% at one point, due to company-specific woes, even as peers climbed. So with less geopolitical tailwind, its weaknesses could resurface. Honorable mention, bear European defense pure plays like Saab or Rheinmetall. These skyrocketed on the war in Europe. If peace emerges, they could see sharper corrections than U.S. peers. For instance, on that late 2025 peace rumor day, Saab fell 5.5% intraday. However, these may be outside our U.S.-focused ticker list, so they're just noted conceptually. CNBC.com. Risk level and rationale. We rated defense risk as medium. Why not high, given it's war-related? Because, ironically, in a portfolio context, defense stocks are often seen as stabilizers during crises. Their revenues are government-backed and somewhat insulated from consumer economy swings. Even if a war ends, most countries have learned to keep defense budgets higher permanently. Structural increases in defense budgets are underpinning valuations. So defense stocks might dip on peace, but not crash, especially as new threats can emerge anytime. The main risk is if you pay a peak price at the height of war euphoria. There could be a valuation air pocket if geopolitics suddenly calm down. But absent a dramatic peace dividend event, defense companies now have multi-year visibility. As one analyst put it, the geopolitical outlook in the short term looks more encouraging, peace, but medium and long term still looks precarious, meaning defense is a long-term story despite near-term news-driven volatility. CNBC.com. Key catalysts to watch: ceasefire or peace treaty headlines, especially for major conflicts like Ukraine. These can hit defense stocks intraday. On the upside, watch for new conflict outbreaks, e.g. hypothetical conflict in Taiwan or Iran. Defense names would likely gap up. Also watch U.S. congressional defense budget bills and NATO members' spending commitments. Surprisingly strong budgets can extend the bull case, even absent new wars. And don't forget earnings reports. If companies like Lockheed report blowout orders or raise guidance, often citing geopolitical demand, stocks will react accordingly. Conversely, if supply chain issues, like component shortages, limit their ability to capitalize on demand, that could temporarily weigh on shares. We saw some of this with Lockheed struggling to meet Ukraine demand due to rocket motor shortages. Now, having armed ourselves with knowledge of defense, let's move on to the digital battlefield of the cybersecurity sector, which in modern times goes hand in hand with kinetic warfare. Cybersecurity sector overview. In today's world, cyber warfare is a central front in any geopolitical conflict. Thus, the cybersecurity sector often experiences a bullish surge during conflicts, sometimes even more so than traditional defense, as nations and companies scramble to fortify their digital defenses against heightened cyber attacks. Our framework gave cybersecurity a high bullish bias and low bearish bias, with high overall risk, meaning plenty of upside in conflict, and investors are bullish, but also a very volatile, fast-moving space. Why high risk? Because these are often high-growth tech stocks that can swing wildly with sentiment, and the threat landscape is unpredictable. Bull case. Every major geopolitical flare-up now comes with a spike in cyber attacks and digital espionage. State-backed hackers and hacktivist groups ramp up operations. For example, the Russia-Ukraine war unleashed waves of cyber attacks on infrastructure and businesses around the globe. The recent Israel-Gaza conflict similarly saw a hacking attempt for various sides. This drives surging demand for cybersecurity products and services. Threat detection, network defense, cloud security, endpoint protection, encryption, you name it. Governments invest more in cyber defense. Companies in critical industries, energy, banks, telecom, etc., raise their security budgets. As a result, cybersecurity firms' revenues can jump and investors often bid up their stocks during conflicts. We've seen historic bullish performance in some cyber names aligned with geopolitical events. For instance, Palantir, PLTR, while not a pure cybersecurity firm, more of a defense analytics/AI play, saw its stock price multiply in 2023 partly on its involvement in Ukraine and demand for its intelligence platforms. More directly, CrowdStrike, CRWD, and Palo Alto Networks, PNW, had strong rallies in late 2022 and 2023 as high-profile cyber incidents, some tied to geopolitical actors, kept cyber risk in focus. Notably, Palo Alto Networks is up about 17% in 2025 through early November, outperforming the S&P, and it beat earnings expectations amid robust demand. The Amplify Cybersecurity ETF, HACK, also gained 14% in 2025, signaling broad strength. RESecurity.com, Indexbox.io. During the initial Russia-Ukraine invasion, cybersecurity was labeled a high priority. NATO countries bolstered cyber defenses. Ukraine relied on firms like Microsoft and Palo Alto to fend off attacks, and Russian cyber activities prompted countermeasures. This environment plays directly into the sales pipeline of major cyber vendors. CrowdStrike CEO openly discussed increased interest from governments needing proactive threat hunting due to Russia. Meanwhile, options market action has shown traders betting on cybersecurity upside during conflicts, e.g., call option volume spike for CrowdStrike and Zscaler during periods of elevated cyber threat. As mentioned in our framework, call open interest jumped on PNW and CRWD with conflict news. Indexbox.io, another angle. Cyber intelligence. Companies that do threat intel and cybersecurity consulting, like Mandiant, acquired by Google, or smaller firms like Recorded Future, see business boom as clients seek expertise on nation-state threats. While many of those aren't standalone tickers anymore, it underscores the theme. Conflict equals more cyber spend. Time frame. The reaction can be immediate. If a war breaks out, within days you might see cybersecurity stocks pop on expectations of increased spending. For example, right after the October 2023 Hamas attack, cybersecurity stocks rose on speculation of more cyber conflict in the Middle East. There were reports of hackers targeting Israeli systems, etc. However, the revenue realization takes a bit longer. New contracts might ramp up over a few quarters. Still, Wall Street tends to price in the opportunity quickly. Often, sustained conflict leads to a sustained uptrend for the sector, beyond the initial pop, as each high-profile hack or virus outbreak serves as a reminder and catalyst for companies to invest in security. Point 1 Caution. Cybersecurity is also tied to the broader tech sector. In 2022, these stocks initially jumped on Ukraine war news, but then sold off with the tech bear market despite strong demand, only to rebound later. So, macro conditions, interest rates, can moderate the pure geopolitical trade in cyber. That's why it's a high volatility area. Bullish tickers. Top 3. Long Palo Alto Networks. PNW, a leading all-around cybersecurity provider, firewalls, cloud security, AI-driven threat detection. Bull case. PNW is often considered the blue chip of cyber. In times of conflict, large enterprises and governments turn to vendors like Palo Alto for comprehensive security solutions. The company has noted strong demand from digital espionage threat, e.g., its platform helps defend against nation-state hackers. Financially, Palo Alto has been executing well. Recent earnings beat estimates with 16% revenue growth. In a high-threat environment, PNW can upsell new services like threat intelligence feeds, advanced AI analytics for detecting intrusions. The stock has delivered solid gains during recent conflict periods. It's up 17% YTD in 2025 thanks in part to persistent cyber threats. Time frame. Medium term. Each quarter of elevated cyber incidents could translate to top-line growth and stock appreciation for PNW. Also, as a profitable cyber company, it's less vulnerable to rising rates than some smaller peers. It can hold its value better if macro turns choppy, making it a relatively safer bet to ride the conflict-driven trend. Indexbox.io, CrowdStrike. CRWD, a pioneer of cloud-based endpoint security and threat response. Bull case. CrowdStrike's Falcon platform is widely used to stop breaches in real time. During wars, when we see spikes in ransomware and state-sponsor hacking, CrowdStrike's incident response teams are on the front lines. For instance, they were deeply involved in protecting Ukrainian infrastructure and global clients from spillover threats in 2022. The company often publishes reports about nation-state actors, e.g., identifying Russian or Chinese hacker groups, which enhances its reputation and brings in business. Options traders have been known to load up on CrowdStrike calls when cyber tensions rise, as per anecdotal data. Fundamentally, CRWD has been growing revenues 30–40% annually. A conflict could push more enterprises to adopt CrowdStrike's services faster, accelerating customer additions and ARR, annual recurring revenue. Time frame. Short-term spikes on big cyber attack news, e.g., if a major government or bank is hacked. These headlines often coincide with bump in cyber stock prices. Longer term, sustained conflict could boost subscription growth over a year or more. Fortinet. FT&T, a major network security firm known for firewalls and network appliances, and also expanding into cloud security. Bull case. Fortinet often benefits when companies upgrade their network perimeters, something they rush to do after high-profile breaches. Geopolitical hackers often find network loopholes, so firms might invest in better firewalls/VPN security from Fortinet. FT&T also serve a lot of critical infrastructure clients, energy, industrials, which are on high alert due to threats, e.g., the U.S. Power grid operator NERC warned that geopolitical conflicts like Ukraine/Gaza have dramatically increased cyber threats to energy grids, prompting utilities to spend more on cybersecurity. Fortinet's products can be part of that solution. The stock had a setback in mid-2023 on a sales slowdown, but that sets it up for potentially strong upside if demand reaccelerates due to geopolitical urgency. It's also one of the few profitable, cash-rich companies in the sector. Time frame. Medium, new product deployments can take months. However, FT&T stock could re-rate quickly if they report a big pickup in orders from government/critical infra clients in the next earnings cycle following conflict. resecurity.com. Alternate picks. Zscaler ZES. Cloud security specialist. Highly valued but could surge on increased cloud attack fears. Okta. OKTA. Identity security, which becomes crucial after espionage-related breaches. Though Okta has had its own security lapses, SentinelOne is an endpoint security rival to CrowdStrike. More speculative, but would benefit from the same trends. Bear case. On the flip side, could cybersecurity stocks fall if geopolitical risks fade? Possibly, but the case is less direct than for defense. Cyber threats don't vanish with a peace treaty. If anything, state-sponsored hacking often continues, even in peacetime. However, the urgency and growth premium might diminish. The bearish scenarios are more about the sector's high valuation and competition. If the world enters a détente with fewer headline cyber incidents, companies might feel a bit less pressure to rush purchases, slowing the blistering growth some cyber firms have enjoyed. Also, many cybersecurity stocks trade at rich multiples. They could pull back if investors rotate from risk-off when they wanted security stocks back into cyclicals or other sectors in a stable geopolitical climate. Another bear trigger. Tech market downturn. Cybersecurity is part of tech. In a broad market sell-off or if interest rates spike, these stocks can fall hard, conflict or not. We saw this in early 2022. Despite heightened cyber attacks around the Ukraine invasion, CrowdStrike, Zscaler, etc., dropped 20 to 30% because the Nasdaq was sinking on macro factors. So a peace scenario combined with a hawkish Fed or recession could smack cybersecurity shares. Bearish tickers. 3 examples. Short/avoid Zscaler. ZS, a cloud security pioneer. Zero Trust Exchange. Bear case. Zscaler has been a high flyer with a very high PE. If the urgency for remote work security and emergency upgrades ebbs, which could happen if organizations feel they've already locked down or if budgets tighten post-conflict, ZS's growth could slow and the stock, which is priced for perfection, might tumble. It's also in a fiercely competitive niche. Palo Alto, Cisco, and others have zero trust offerings now. In a stable geopolitical period, the relative shine of Zscaler might fade as investors choose more value-oriented names. Put another way, ZS thrives on the narrative of urgent need for best-in-class cloud security. Remove the urgency, and its valuation could compress. We'd expect high volatility here. ZS could easily swing down 20% or more on any hint of growth deceleration. Okta. OKTA. Okta specializes in identity and access management, crucial for security. But Okta has had some notable breaches of its own. In 2022 and 2023, hackers compromised Okta support systems, causing reputational damage. Bear case. If overall cyber spending enthusiasm cools, customers might stick with what they consider core, network and endpoint security, and be slower to invest in things like identity solutions. Okta also is still unprofitable and has had execution issues. In a less dire threat environment, its high-growth story might not compensate for those concerns, leading to stock underperformance. Essentially, Okta is a bit more optional relative to frontline cyber defense, and its face credibility hits. A business-friendly, peaceful climate might lead companies to focus on other IT priorities than revamping identity management, leaving Okta in the cold. Call to action. If you found this deep dive helpful, please subscribe to our podcast, rate the show, and download episodes for future reference. Your support helps us keep analyzing and delivering insights each week. Also, check out our sponsored snacks at My Deals Shop. Yes, you heard right. You can browse curated Shopify stores selling luxury snacks at great prices. Not only do you get a discount on deluxe trading-boosting snacks, think caffeinated chocolates, health-boosting matcha, craft non-alcoholic cocktails, and even CBD-infused seltzers, available in limited jurisdictions, but your purchase helps support the show. It's a win-win. Fuel your body and mind for those long trading sessions. Just follow our special link in the show notes to My Deal Shop. Enjoy the treats, it helps the show, and then get right back to the market action. Enough on that, back to the show. Thank you for listening to JMoney/FIAIYT. Stay safe, stay informed, and we'll catch you in the next episode, where hopefully we'll be discussing a more peaceful market environment. Until then, happy investing. Sources: Sentinel-1. Sentinel-1 is CrowdStrike's smaller rival in endpoint security. It boomed during 2020-2021 IPO hype, but has since struggled. The stock plunged in 2023 after cutting guidance. Bear case: it's still heavily cash-burning and trying to gain market share. In a scenario where cyber spending isn't accelerating, say, because geopolitical tensions ease, Sentinel-1 might find it harder to steal customers from CrowdStrike or convince budget-conscious IT departments to add another tool. Any disappointment, and this stock can dive given its past volatility. Also, if peacetime means less ransomware frenzy, smaller vendors like could lose the urgency factor that sometimes helps them pitch their innovative tech. Notably, Sentinel-1 recently had to lay off employees, and its growth has slowed. Any further headwinds could make an underperformer. In general, truly bearish cases for cyber might require a combo of fewer threats and bad financial execution. It's worth noting that even in more peaceful times, the baseline of cyber attacks, criminal, espionage, etc., remains high in our digital age. As the saying goes, cybersecurity is a growing need in any environment. Only the slope of growth changes. So, the sector might not crash absent geopolitical risk, but individual high multiple stocks could correct. Risk level: we rated cybersecurity as high risk. This reflects stock volatility and the fact that the sector's fortunes can reverse quickly if growth slows, or if a new competitor emerges with a hot product. Also, many cyber firms trade at growth stock valuations which can swing with investor risk appetite. However, qualitatively, the risk of demand falling off a cliff is low. Cyber is often called recession-proof to a degree because hacks don't stop in a recession. The volatility is more about how much optimism is baked into prices. Right now, with constant headlines of breaches, from ransomware on hospitals to espionage on infrastructure, there's strong optimism. If that abates, these stocks could chop down 10 to 20% just on sentiment. Conversely, a single massive cyber incident can send them jumping again. Catalyst to watch: obviously, major cyber attacks linked to geopolitical actors. For example, if a state-sponsored group hits a big U.S. bank or power grid, causing an outage, expect an immediate rally in cyber stocks as that news hits the tape, similar to how defense stocks jump when missiles fly. Also watch government policy. Increased funding for cybersecurity and budgets, Biden administration cyber initiatives, or NATO cyber defense commitments all support the sector. On the flip side, if we get a period of surprisingly few cyber incidents, or if a leading company issues a warning of slowing growth, a bad earnings report, that could indicate that the conflict-driven boost is waning, which would be a bearish signal. Finally, M&A can be a factor. Larger tech or defense firms might acquire cybersecurity companies to beef up capabilities in tense times. For instance, in 2022, Google bought Mandiant, and just recently Cisco announced a $28 billion acquisition of Splunk, partly for security analytics. M&A rumors can spur rallies too. Transitioning from cyber, which operates in the shadows, let's turn to a very tangible and visible sector impacted by conflict. Energy, specifically oil and gas. This one's classic. War often means oil supply fears, and oil price swings have huge market repercussions. Energy sector, oil and gas. Overview. The energy sector, particularly oil and gas companies, often rides a roller coaster during geopolitical crises. Conflict in oil-rich regions, Middle East, Russia, tend to push oil prices up on fears of supply disruptions, benefiting oil producers in the short term. However, the relationship isn't one-directional or permanent. Extended conflict can also dampen global growth, cutting demand, or prompt extra supply from other sources. So energy in our framework had a medium bullish bias and medium bearish bias, with medium risk level. In simpler terms, it's a mixed bag. There's opportunity for gains, hence some bullish bias, but also high volatility and potential reversals, hence also bearish concerns. Risk is medium because while oil prices swing wildly, many big energy companies are cash-rich and somewhat resilient, plus governments intervene, via reserves, etc., to stabilize markets. Bull case, oil price spikes are the key driver. When war erupts in an oil-producing region or involves major powers, traders fear supply outages. Think of the 1970s oil embargo during Middle East wars, or more recently, the uncertainty around Iran, a major producer, possibly being drawn into conflict. A current example, the war in Ukraine and subsequent sanctions on Russia took a large chunk of supply off Western markets, helping Brent crude surge to $120/barrel in early 2022. Similarly, the Israel-Hamas conflict in late 2023 raised concerns of escalation involving Iran, which could knock several million barrels per day offline. Analysts warned oil could soar well above $100 if a regional war broke out. Even talk by leaders can move oil. E.g., in August 2024, President Biden's comments about a potential Israeli strike on Iran's oil facilities caused a jolt in oil markets. CNBC.com. CNBC.com. Higher oil and gas prices are obviously great news for oil companies' profits. Thus, integrated majors like ExxonMobil, XOM, and Chevron, CVX, as well as large independent producers like ConocoPhillips, COP, or BP plc, BP, stand to gain. For instance, Exxon and Chevron posted record profits in 2022 when oil soared on the Ukraine war. Exxon made over $55 billion, an all-time high in 2022. Their stock prices responded. ExxonMobil's stock jumped 80% in 2022. In 2023, as oil recovered from mid-year lows to $90 toward year-end, partly on war fears and OPEC cuts, energy stocks had another run. Halliburton, HAL, and Schlumberger, SLB, which provide drilling services, also thrive when oil companies ramp up new projects to capitalize on high prices. U.S. News noted that higher oil prices could mean more profits and higher share prices for U.S. oil and gas companies, such as Targa Resources, Schlumberger, Halliburton, in the context of Middle East tensions. Money.usnews.com. Additionally, natural gas markets can be affected, e.g., Europe faced a gas crisis due to the war, benefiting gas exporters, like U.S. LNG companies. So bullish tickers extend to LNG players, e.g., Cheniere Energy, LNG, or Targa Resources, TRGP, which was mentioned. Money.usnews.com. Time frame. Oil prices often react within minutes of geopolitical news. It's one of the fastest reflexes in markets. The immediate effect on oil company stocks might be positive, but sometimes muted on day one, as broader indices may be down on war news. However, if elevated prices sustain, within days and weeks energy stocks tend to strengthen as investors see the earnings bonanza coming. Historically, oil shocks from conflict can last months. That said, oil is notoriously cyclical. It might spike quickly but can also reverse if the situation stabilizes or if other producers compensate. So energy investors ride a shorter cycle, sometimes measured in weeks or a few months around the conflict's acute phase. For example, when Russia invaded Ukraine in February 2022, oil spiked through March. By summer 2022, oil actually fell back as markets adjusted and global growth fears took over. Many oil stocks peaked around June 2022, then pulled back. Another case, the Persian Gulf War, 1990-91. Oil spiked before the U.S.-Iraq conflict, but once it became clear the war would be quick and successful, oil prices plunged dramatically, and energy stocks gave back gains. So bull phases can be sharp but short-lived unless the conflict causes a structural supply deficit. Right now, the structural backdrop is that OPEC Plus, led by Saudi and Russia, is deliberately limiting output to keep prices up. Geopolitical risk adds to that. So we have a scenario of already tight supply plus war risk premium. That favors an ongoing uptrend in oil prices, benefiting stocks over a medium term, say 6 to 12 months, if multiple conflicts continue with no resolution. Bullish tickers. 3 picks. Long ExxonMobil, XOM, the largest Western oil major. Bull case. In times of high oil prices, Exxon essentially mints money. It has upstream, production, operations globally, so any price increase flows straight to its bottom line. It's less directly exposed to any one conflict region, diversified globally, but benefits from general price rise. Exxon is also expanding LNG exports and even buying shale companies to boost reserves. Recently announced acquisition of Pioneer Natural Resources. With oil in the $80 to $100 range, Exxon's cash flow soars, enabling big shareholder returns, dividends, buybacks. The stock in 2022 to 23 reached multi-year highs, and as of late 2025, is up 9% for the year, continuing to slightly beat the broader market. If Middle East tensions do escalate, e.g., some supply from Iran is lost, ExxonMobil could see another leg higher. Time frame. Short term, it moves with oil price headlines daily. Medium term, each quarter of elevated oil will show up in earnings and likely push the stock to new highs. It's also a relatively defensive way to play conflict. Exxon won't double overnight, but it can steadily grind up and pays a nice dividend, 3.5%. Chevron, CVX, another super major, similar logic to Exxon. Bull case. Chevron has slightly more concentration in certain regions, e.g., big Permian shale presence, and some assets in Middle East and Asia. It benefits from oil spikes and also natural gas. It's big in LNG via its Australian projects. Notably, Chevron and Exxon stocks often move in tandem with oil prices, and both were up strongly in conflict-driven periods. For instance, Chevron climbed 50% in 2022. It's been a bit behind Exxon in 2023 to 2024 performance, so there could be catch-up. Catalyst. If oil hits, say, $100 plus, Chevron's profits will likely break records as well. Additionally, any resolution of its recent disputes, like strikes at Australian LNG facilities, could be upside. Time frame. Same pattern. Immediate reaction to oil swings, and a strong intermediate-term tailwind from sustained higher commodity prices. ConocoPhillips, a large independent oil and gas producer, no refining business. Bull case. Conoco is heavily tied to the price of the commodities it produces, with large operations in U.S. shale, as well as projects in places like Alaska and LNG in Qatar. It is more of a pure play on oil price than integrated majors, which also have refining that can lose when crude prices rise too much. So in a geopolitical oil spike scenario, COP's earnings can jump even more proportionally. Conoco has also been expanding. It bought Concho Resources in 2021 to grow shale output. If war risk keeps oil high, Conoco stands to generate massive free cash flow. The stock has been strong over recent years and tends to outperform integrated majors when oil is in an uptrend. Time frame. Very tied to near-term oil. More volatile than XOM/CVX, but potentially more leverage for gains if oil shoots up. Also bullish. BP plc, BP. Albeit BP had a one-time hit from exiting Russia investments, it's still benefiting from high prices now. Shell. Another European major. EOG Resources, EOG, or Devon Energy, DVN. Shale producers that do great with high oil. Occidental Petroleum, OXY. Another big U.S. producer, famously backed by Buffett, would profit from an oil windfall. Bear case. Here's where it gets tricky. Energy can turn bearish fast if the geopolitical risk abates or if other forces counteract the conflict. Key bear triggers. Peace or de-escalation in conflict zones, e.g., a ceasefire with Iran's blessing could ease oil supply fears. Increased output elsewhere, e.g., the U.S. or OPEC step up production to fill gaps, or demand destruction. If war drives the global economy into recession, oil demand can fall sharply. Historically, many war-driven oil spikes have been followed by crashes. For instance, as mentioned, after the first Gulf War started, oil prices collapsed from $40 to $20 as it became clear the supply disruption would be short. Energy stocks that had run up gave back gains. Another factor, governments might intervene, e.g., release Strategic Petroleum Reserves, SPR. The U.S. did this in 2022, dumping oil from the SPR to temper prices. If, say, oil jumps too high now, the U.S. could once again flood the market with reserves, capping the upside for oil companies. Additionally, the renewables and political pressure angle. When war causes consumer hardship via gas prices, governments may accelerate moves to alternative energy or impose windfall taxes on oil company profits, as some countries in Europe did in 2022. That could be bearish for fossil fuel stocks. Finally, one must consider that energy equities often price in oil moves in advance. If investors think the conflict risk premium has overshot, e.g., oil at $100, but likely to fall back, they might sell energy stocks even while oil is high, anticipating the drop. Energy stocks sometimes diverge from spot oil if the futures market expects reversal. Bearish tickers. 3 examples. Short/avoid airlines and travel companies. As indirect oil bears, it may sound odd, but one way to express a bearish view on energy, or rather, on sustained high energy prices, is to short airlines or cruise lines. These sectors get squeezed by high fuel costs. We'll discuss airlines in their own section next, but suffice it to say, if war-driven oil spikes persist, airline stocks plummet. Exactly as seen in late 2023, when rising jet fuel costs and conflict fears helped knock airline indices down 30%. So, American Airlines, L, or United Airlines, UL, could be seen as bearish oil plays. When oil eventually recedes, those stocks might recover, so shorting them is indirectly a bet oil will stay high or rise more. Similarly, Carnival, CCL, and Royal Caribbean, RCL, have high fuel costs and suffer from both the cost side and potential drop in demand if travel sentiment weakens. Essentially, rather than shorting Exxon, which is risky if oil stays high, one might short energy consumers like transport stocks as a proxy that war effects won't last forever. CNBC.com, refining companies. Interestingly, oil refiners like Valero, VLO, or Marathon Petroleum, MPC, can be negatively affected by crude spikes. Refiners buy crude oil as input and sell gasoline, diesel, etc. If crude skyrockets faster than fuel prices, their margins get squeezed. During rapid conflict-driven spikes, refiners often underperform integrated producers. For a bearish conflict trade, one might avoid or short refiners since a piece, oil down, would actually help them. So, conversely, war hurts them. Now, refiners do benefit if there are product shortages, but generally, extreme crude volatility is hard for them to manage. If we anticipate oil prices will settle or drop, refiners could bounce, meaning they were relatively bearish during the spike. In 2022, for example, refining margins did well because fuel prices also rose strongly due to lack of refining capacity. But if a war premium in crude isn't matched by a war premium in products, refiners get pinched. Renewable energy stocks, short-term while long-term renewables benefit from energy security focus. In the short run during a war, renewable stocks, like solar and wind companies, sometimes lag or decline. Why? Investors rotate into oil for immediate gains, and higher interest rates, often accompanying inflation from oil, hurt renewables, which are capital-intensive. One could argue shorting or underweighting a name like NextEra Energy Partners, NEP, or solar ETFs during the conflict spike is a play that the market will favor oil over clean energy in the immediate term. However, this is a nuanced, possibly too indirect bear target. Another angle, oil importers, e.g., emerging markets that import most of their oil, have stocks or currencies that suffer when oil is high, but that's outside our sector scope. Focusing back on the sector itself, one could simply pick some oil stocks that might be overpriced relative to reality. For example, if Brent crude retreats to $75 on piece, a company that's hugely leveraged and needs $100 oil to justify its price, maybe a high-cost producer, would fall. Think of smaller, debt-heavy shale companies or oil sands producers. But since the user asked per sector, we'll keep this conceptual. Risk level. We labeled energy risk as medium. Volatility in commodity prices is high, which argues for high risk, but many of the big oil companies have become quite financially stable, which tones it down. They have low debt, disciplined spending, and in some cases even benefit from volatility by trading operations. Also, if oil spikes too high, governments intervene to calm it, somewhat limiting extremes. So medium felt right. Risks are definitely present, as anyone who traded oil in 2020 when it went negative knows. But the sector's largest players can weather storms. There's also a natural hedge. If war ends, removing the bullish case, that usually is good for global economy, which can in turn support baseline oil demand. So oil might not crash too far. On the other hand, a recession or new pandemic, unrelated but possible, could absolutely tank oil demand and blindside the oil bulls. Catalyst to watch. Clearly, any news on talks or escalation in conflict, e.g. if we hear the U.S. and Iran back-channeling to avoid war, oil could drop, hitting energy stocks. Conversely, an attack on an oil facility, like if a major pipeline or tanker route is disrupted, could send oil up and lift energy stocks dramatically within hours. OPEC meetings are big too. OPEC's reaction to war. Do they pump more to stabilize or hold back? So far, OPEC has kept cuts despite war, aiding the bulls. Also watch inventory data and demand indicators. If data shows demand destruction, e.g., significantly lower oil consumption because prices are high, that could flip sentiment bearish even while conflict persists. And as always, macroeconomic policy. If oil prices cause inflation to spike, central banks might raise rates more, which could paradoxically hurt equity markets broadly, including possibly capping energy stocks upside if investors fear policy tightening. All right, we've covered 3 sectors that often benefit from turmoil. Now let's pivot to those that typically get hurt by it. The first and most immediately impacted, airlines. Airlines sector overview. The airline sector is highly sensitive to geopolitical risk and is usually bearish biased during conflicts. Travel is a discretionary activity that people curtail when they feel unsafe, and airlines also face the double whammy of rising fuel costs when oil prices spike. Our matrix pegged airlines with low bullish bias, high bearish bias, and high risk overall. Indeed, airlines are often among the worst performers in times of war or terror threats. However, there can be a silver lining, the bull case. Once things settle, pin-up travel demand can rebound strongly if a conflict ends or if a feared scenario doesn't materialize. But generally, war equals bad for airlines. Money.usnews.com. Bear case. Primary scenario in a conflict scenario, especially one that either involves travel hubs or triggers broad safety fears, air travel demand falls. Tourists cancel vacations, businesses cut back travel, and certain air routes may be shut for safety, e.g., many airlines rerouted or suspended flights over conflict zones like Ukraine or around the Middle East if missiles fly. If the conflict is global or involves major powers, there can be generalized fear of flying or travel far from home. After the 9/11 terrorist attacks, not a state-to-state war, but relevant to geopolitical risk, U.S. airline demand collapsed and took years to fully recover. Similarly, when Russia invaded Ukraine, flights to Russia, Ukraine, and surrounding areas stopped. Some Asian routes had a detour, longer flights, higher cost. U.S. to Asia flights were affected by Russian airspace bans. All these mean lower revenue and higher operating costs. At the same time, as discussed under energy, wars often raise fuel prices. Jet fuel is usually an airline's number 1 or number 2 expense. A surge in oil can cripple airline profit margins unless they hedged fuel in advance. Some do, some don't. For instance, in late 2023, oil's rise toward $90 to $100 pushed up jet fuel prices 30%, and airlines like Delta warned of higher costs impacting their earnings. Indeed, headlines from September 2023 noted oil prices are pressuring airline stocks. Barclays analysts recommended option strategies to short airlines given fuel costs, as airlines get hit from both demand side, fewer passengers, especially lucrative international and business travelers, and cost side, expensive fuel. The result, stock prices dive. As cited earlier, airlines lost about one-third of their value in late 2023 over a few months, a combination of war outbreak and fuel inflation. The U.S. Global Jets ETF, JETS, which tracks airline stocks, fell sharply in such periods. CNBC.com, notable example. The NYSE ARCA Airline Index, XAL, was around its 2023 highs in July. By November 2023, it was down 30%. U.S. News reported that Marriott Vacations, a proxy for travel demand, plunged 30%, and Norwegian Cruise Line 19% in 6 months amid conflicts, reflecting travel industry pain. Though those are hospitality, they reflect similar trends for airlines. Within airlines, generally the more international exposure, the harder the hit, because war typically impacts international travel more than domestic. Also, airlines with weaker balance sheets suffer more as revenue falls. E.g., American Airlines, L, with its heavy debt load, is often seen as one of the most vulnerable. Money.usnews.com. Time frame. The market typically immediately sells off airline stocks when war news hits. It can be an overreaction initially. Sell first. Ask questions later. Then, as actual data on bookings comes in, further declines can occur if indeed bookings drop. So there's an immediate shock, days, and a medium-term trend, months of depressed demand. If conflict is prolonged, airlines may guide down earnings for several quarters. During the 2020 COVID crisis, not geopolitical but analogous in demand shock, airline stocks stayed very low for months until visibility improved. Airlines also can rebound quickly if risks recede. They're high beta. For instance, if a feared conflict ends swiftly, say a ceasefire happens unexpectedly, airline stocks could pop on the prospect of renewed travel. But caution, after a conflict, it often takes a while for travelers to regain confidence. E.g., even if the Ukraine war ended tomorrow, tourism to Eastern Europe might remain low for some time, and airlines would still have route network adjustments. So recovery might lag the actual piece. Bearish tickers. 3 picks. Short, virtually all airlines are bearish in a conflict scenario. But if picking 3, American Airlines, ALY short/avoid. American is one of the big 3 U.S. legacy carriers with a heavy international network, transatlantic and some transpacific, and also a large domestic network. It also entered the post-COVID period with the highest debt and most leveraged balance sheet among majors. That makes it vulnerable when revenues drop or fuel costs spike. American has less room to maneuver financially. Historically, in industry downturns, AL tends to drop more percentage-wise than Delta or United. For example, in the late 2023 sell-off, American stock fell to around $10, a large decline, nearing distress levels. If conflicts cause a demand recession, American's profit outlook could swing to losses, putting pressure on its ability to service debt. Catalyst. Further escalation in conflict, or evidence of corporate travel pullbacks. American relies heavily on business travel in key hubs, could send AL down. Conversely, it likely would bounce if macro and geopolitical concerns ease. But as a bear play, AL is a prime candidate. United Airlines. UAL is the most globally exposed U.S. airline. Pre-pandemic, it derived a large chunk of revenue from international routes, especially Asia and Europe. Bear case. United's fortunes are tightly linked to international travel health. The Ukraine war directly affected Europe-Asia flying. United had to detour or suspend some flights to India/other Asia that used Russian airspace. The Israel conflict led United and others to suspend all flights to Tel Aviv. If Middle East conflict widened, United's routes to the region and potentially some connecting traffic could be impacted. Moreover, United has a big Pacific network. If U.S. China/Taiwan tensions, geopolitical risk in Asia, escalate, that's another blow. So United faces multiple theaters of risk. It also does not hedge fuel, meaning it's fully exposed to spot jet fuel prices. CEO Scott Kirby openly said in late 2023 that the surge in fuel and hostilities would likely weigh on earnings. Sure enough, UAL stock took a hit. Thus, UAL is a good representative short on global conflict risk. It tends to have higher beta than Delta, for instance, JetBlue Airways, JBLU to include a smaller carrier. JetBlue represents a mid-tier U.S. airline with a primarily North American network. One might think domestic-focused airlines like JetBlue or Southwest are safer in war, and indeed they are relatively shielded from international demand swings. However, JetBlue is facing its own issues. It's trying to merge with Spirit, which is uncertain due to a DOJ lawsuit, and it's had profitability struggles. It doesn't hedge fuel, so high oil hits it hard. And while domestic leisure travel might hold up better than international, if consumer sentiment turns negative because of general economic uncertainty from war, budget carriers like JetBlue can still suffer. People postpone vacations, etc. JetBlue's stock in 2023 dropped to multi-year lows, under $5 at one point, essentially penny stock territory, reflecting not just war/fuel, but also operational woes. In a protracted high oil environment, a weaker player like JetBlue could even face liquidity problems. Bear thesis: if conflicts keep fuel expensive, and if general volatility stays high into 2024, JetBlue may burn cash, and its merger distraction could compound issues, making it an underperformer or potential bankruptcy candidate in a worst-case extended scenario. Not saying that will happen, but market sometimes fears it. Also bearish. European airlines like Lufthansa, Delaki, or Air France-KLM, which are directly impacted by war in Europe and higher reliance on Russian airspace, etc. Indeed, Lufthansa's stock fell after Ukraine war and has been choppy. And Asia-Pacific Airlines if conflict involves that region, but focusing on U.S. tickers as likely intended. Bull case: peace/rebounding travel now. What happens if geopolitical risks ease? Airline stocks can rebound ferociously. They are cyclical and typically lead the market up in recoveries. If, say, a war is resolved or doesn't spread, people might quickly book trips again, especially leisure travelers with revenge travel impulses. We saw huge pent-up demand after COVID lockdowns eased, a different cause, but shows travel desire is strong. Also, if oil prices drop because tensions ease, that's a huge tailwind. Costs come down significantly, boosting margins. The bullish scenario for airlines is basically a mirror image. Conflict ends or contains fuel prices fall plus traveler confidence returns equals airline earnings surge. And since stocks likely were beaten down, they can rally dramatically. For example, after the Gulf War ended in 1991, airline stocks doubled over the next year as oil fell and travel resumed. More recently, look at early 2022. Once initial shock of Ukraine war passed, and it was clear it wouldn't directly engulf Western Europe, airlines had a relief rally in spring 2022 until recession fears took over later. Therefore, while baseline during conflict is bearish, one should watch for turning points. The bullish tickers in a peace scenario would actually be largely the same companies: L, UAL, DL, Delta, etc. But since we owe the user 3 bull and 3 bear per sector, let's explicitly call out some bullish picks within airlines. Bullish tickers: 3 picks. Long in a resolution scenario, Delta Airlines. DAL Delta is often considered the strongest managed U.S. airline, with a good mix of international and domestic, a loyal customer base, and robust profitability pre-crisis. Bull case: Delta tends to hold up a bit better during turmoil and snap back faster after. If conflict risks subside, Delta is poised to benefit from returning corporate travel. It has strong ties with businesses and high-end leisure. It also has one of the industry's more moderate debt levels and was profitable in 2023 despite headwinds. So in a peace scenario, while all airlines rise, Delta could lead the pack and is a relatively safer bet to capture the upside. Southwest Airlines, love Southwest, is primarily domestic and short-haul, with a focus on leisure travelers. Bull case: Southwest might not drop as much in war times, but in any case, when fear abates, domestic travel usually booms. People feel comfortable flying again, maybe opting for domestic trips if international is risky. Southwest is known for low fares. As oil prices drop post-conflict, it can cut fares or expand capacity profitably, stimulating more demand. Also, Southwest historically hedges fuel aggressively. They often lock in lower prices. that can shield them during the spike and position them to thrive if fuel subsequently falls. If geopolitical tensions ease and oil plummets, Southwest could find itself with fuel hedges in the money plus rising demand. A sweet spot. Its stock would likely climb. Southwest had its own operational issues in late 2022 with a meltdown, but assuming those are fixed, it remains a top airline pick. United Airlines. UAL, yes. United was in bears too. But it's a double-edged sword. If geopolitical clouds part, United stands to gain the most because it has the most to recover internationally. If Asia and Europe routes fully reopen and travelers flood back, United's revenues could soar. For example, a normalization of U.S.-China relations, we can dream, and reopening could massively benefit United and others on trans-Pacific flights. Similarly, an end to the Ukraine war would eventually reopen Russian airspace, cutting flight times/costs for United's Asia routes. A big win. So United could rebound strongly, perhaps more than Delta, which didn't fall as much. It's higher risk/higher reward on the bull side. Also bull picks. European airlines like Lufthansa or IAG would skyrocket if peace in Europe. Booking Holdings, BKNG, which is an online travel agency, not an airline, but heavily correlated, would benefit from resumed travel flows. In fact, Booking has held up well, but would still gain with more travel demand. Essentially, to fulfill the prompt, we have 6 tickers for bull versus bear within airlines. Bullish, DL, Love, UAL, as identified. Bearish, UAL, again, but we'll avoid repeating in final phrasing. Maybe we already put UAL in bear. We might substitute JetBlue for variety. JBLU that will present accordingly. Being mindful not to confuse by listing one ticker in both bull and bear simultaneously in the summary table. Perhaps we use UAL as bear in narrative but list a different one in the final table to have 6 distinct tickers. Maybe use Alaska Air, ALK, or Spirit, Save, in bull or bear to round it out, but we have enough with JetBlue and others. We can mention ALK for bull. It's domestic-focused and often stable. Anyway, let's continue with the general analysis. Risk level. Airlines are high risk. They are notoriously volatile. Warren Buffett likened investing in airlines to a death trap at one point. They can swing from record profits to bankruptcy in short order with external shocks. The combination of high fixed costs, commodity exposure, cyclicality, and now even labor issues, pilots demanding raises in a tight market, makes them risky. The only saving grace is that the industry has consolidated in many countries, e.g., the U.S. Big Four control 80% of the market. So in theory, they have more pricing power now than decades ago. Still, if war triggers a global recession, airlines will be among the first casualties financially. Hence, one should approach them with caution during uncertain times. Catalysts. Clear ones. Travel advisories, government warnings or bans on travel to regions. Airspace closures, e.g., if the FAA bans U.S. airlines from any conflict airspace, which they often do, it can disrupt flights. Like U.S. carriers avoid Iranian, Ukrainian, North Korean airspace, etc. Oil price, track daily. Forward bookings data, airlines themselves or industry data might show bookings down, can be an early indicator. Also, earnings releases from airlines will incorporate any guidance on war impact, e.g., in Q4 2023 earnings. Watch for commentary like, we saw a slowdown in European bookings due to the war, or higher fuel will reduce next quarter's margin. That could move stocks significantly. On the upside, any ceasefire or positive development, even a rumor of peace talks progressing, could spark a relief rally for airline stocks. Now, related to airlines is the broader tourism sector, hotels, cruise lines, online travel agencies. Let's examine that next, which is similarly punished by money.usnews.com. Conflict, tourism and leisure sector overview. The tourism sector, encompassing hotels, cruise lines, theme parks, online travel agencies, OTAs, and destination travel services, is another big loser during geopolitical upheaval. It depends on people's willingness and ability to travel for leisure, which is quickly curtailed when safety is in question. We rated tourism with low bullish bias, high bearish bias, Risk high. There's a famous quote by a former UN World Tourism Chief. Tourism is a peace industry. Where there is war, tourism dies. History shows conflicts decimate tourism in affected regions and can even dent global tourism if the war is prominent enough to scare travelers broadly. The Diploma, Insight.com, Bear Case. The moment conflict erupts in a region, tourism to that region collapses and often neighbors feel secondary effects. Case in point, Ukraine and Russia were receiving tens of millions of tourists annually before 2014. After war, those numbers plunged to near zero. The Ukraine war also led to a noticeable drop in European tourism sentiment in early 2022. A survey showed perceptions of Europe's safety fell, with destinations near the conflict, Poland, Baltics, seen as most dangerous, causing many to postpone trips. Travel between Europe and Asia was also affected by airspace closures and higher costs, indirectly reducing tourism flow. The Diploma, Insight.com, The Diploma, Insight.com, The Diploma, Insight.com. Another example. The current Middle East conflict, Israel-Gaza, has devastated tourism in Israel and nearby countries. Israel's booming tourism, immense in 2019, vanished overnight in October 2023. Neighboring Egypt and Jordan likely see fewer visitors too, as some travelers avoid the region entirely during violence. Cruise ships have rerouted away from Israeli ports. Terrorist attacks or war threats also reduce international tourism in general, as people adopt a wait-and-see approach or choose perceived safer destinations, e.g., during Gulf War 1991, many avoided Middle East travel entirely. After September 11th, global tourism took a hit for months. Cruise lines, extremely sensitive as well. Who wants to be on a cruise in the Mediterranean if a regional conflict is flaring? Cruise companies often redeploy ships away from troubled waters, but that disrupts schedules and can hurt bookings even in other regions, fewer European cruises, etc. During the Ukraine crisis, Black Sea cruises were canceled entirely. Ports like Odessa off-limits. Hospitality. Hotels in war-affected cities obviously suffer. Occupancy drops to near zero, except maybe journalists and aid workers. Even hotels in major global cities can see fewer international guests if long-haul travel dips. OTAs. Online travel agencies like Booking.com, Expedia, etc. see lower bookings if travel demand falls. Theme parks and attractions. If war causes economic strain or fear, fewer tourists visit major sites. Though domestic visitors might cushion the bear case is straightforward. Less tourist volume, revenue plummets. Many tourism firms still have high debt from COVID losses, so they come under financial stress again. Cruise lines, for example, took on huge debt during COVID. They were recovering in 2023 with record demand, but if war or recession slows bookings, they could face liquidity issues. We already cited that Norwegian Cruise Line, NCLH, stock fell 19% in 6 months due to war pressures, and Marriott Vacations Worldwide, VC, represents timeshare resorts, was down 30%. Also, Carnival, CCL, and Royal Caribbean, RCL, stocks dropped in late 2023 after having soared earlier that year. The war news certainly paused their rally. Money.usnews.com. Time frame. Immediate drops in travel bookings in affected markets. Within days, cancellation spike. The stocks tend to react fast too. E.g., Expedia and Booking shares fell in October 2023 around war outbreak on expectations of lower bookings. Booking has significant Europe business, including Israel tourism via subsidiary. If conflicts persist, each quarter's earnings for these companies will show the damage. Q4, Q1 usually weaker if war ongoing. Like airlines, these can recover quick once situation normalizes, but typically slower because people take time to plan vacations. So the trough might last longer until consumers clearly feel conflict is over. Bearish tickers. 3 picks. Short/avoid Carnival Corporation. CCLY short. Carnival is one of the world's largest cruise operators. Owns Carnival, Princess, Holland America, etc., with a lot of exposure to global cruising. It has very high debt from pandemic. It was enjoying a resurgence in 2023 with strong bookings, but any disruption like a war or just sustained high fuel costs Bunkering fuel for ships is significant, can derail that. Carnival's customer base is global, and a portion are older travelers who may be more cautious in times of geopolitical instability. Also, if the conflict causes economic slowdown, consumers might pull back discretionary spending on cruises. Already, in mid-2023, Carnival warned about fuel and currency headwinds. Adding war sentiment could hurt winter cruise bookings in Europe/Mediterranean or even other regions if Americans choose to stay closer to home. Carnival stock is volatile. It fell from $19 to $11 from July to October 2023 when war and fuel became concerns. Bear thesis: if conflicts escalate or drag, Carnival could retest pandemic-era lows as investors fear it won't fully recover before the next downer hits. Booking Holdings, BKNG Booking, owner of Booking.com, Kayak, Priceline, etc., is the world's largest online travel agent, especially strong in Europe. Why short? Booking's revenues depend on global travel volumes. In 2022, they rebounded strongly as travel reopened, hitting record earnings by 2023. But they themselves said the Ukraine war had a negative impact on European bookings initially. If war anxiety persists, and now we have Middle East too, some travelers may delay transatlantic trips, hurting Booking's bread-and-butter hotel reservation business in Europe. Also, Booking stock has been riding high near all-time highs. It could be vulnerable to a downward revision if growth slows due to macro/geopolitical issues. It's a high-priced stock, $3,000/share, and could easily correct 10 to 20%. In war times, investors often rotate out of travel-exposed tech like BKNG into safer assets. So Booking is a good short-term proxy to short travel demand. One must note, though, Booking is very resilient and has a strong cost structure, but we're talking stock moves, not company survival. Expedia Group. Expedia is another OTA. Expedia, Hotels.com, VRBO, with substantial exposure to North American travel and some international. Why short? Expedia has underperformed Booking and execution and was more directly impacted by issues like conflict or COVID. It's smaller, less diversified. If Americans get skittish about travel or Europe inbound slows, Expedia's growth could stall. Additionally, Expedia is more exposed to vacation rentals now. VRBO. If war-related uncertainty or economic issues arise, families might postpone renting a vacation home in Europe, etc. Expedia stock has already been relatively weak. Further conflict could push it down to new lows. It also tends to react negatively to negative travel headlines more so than Booking, which is seen as more robust. Additionally bearish, Disney, DS, specifically its theme park segment, might see fewer international visitors to U.S. parks, and its cruise line suffers, though Disney has many other business lines. Marriott International, MAR, or Hilton, HLT. Big hotel chains could see occupancy declines in some markets and stock pressure. Indeed, in November 2023, Marriott stock dipped on travel concerns. Airbnb, reliant on global trips, could face fewer bookings or host cancellations in war-affected locales. We saw Airbnb suspend operations in Russia in 2022, etc. So Airbnb might also catch some downside from conflict, and it's a richly valued stock that can be volatile. Bull case, post-conflict bounce. The flip side is powerful. Travel is a fundamental human desire, and once safety is assured, there's often a surge of pent-up tourism. After the defeat of COVID travel bans, we saw a massive travel boom in 2022 to 2023, referred to as revenge travel, that lifted airlines, hotels, and cruise lines dramatically. A similar, though maybe smaller effect can happen after wars. People who deferred that Mediterranean cruise or Israel pilgrimage might book for next year if a peace treaty is signed. Additionally, often currencies in war-adjacent regions weaken, making travel there cheaper for foreigners once it's safe, which can stimulate tourism. For example, if Ukraine war ended, one could imagine tour operators advertising, "Visit beautiful Ukraine. Help it rebuild by touring its cities." There will be some who actually do that. Countries like Poland and Baltic states, which lost tourism because perceived as near conflict, would likely see a rebound in visitor interest. And if Middle East tensions simmer down, popular destinations like Israel, Egypt, Jordan will see tourists return. Israel had a record tourism in 2019. They'll want to rebuild that industry. So the bullish case for tourism sector banks on peace and stability returning. That could send these stocks soaring from depressed levels. As we noted, Marriott Vacations and cruise lines dropped. They'd likely bounce back strongly when conflict risk ebbs. Bullish tickers. 3 picks. Long Royal Caribbean. RCL Royal Caribbean is another big cruise company, and it's been executing better than Carnival. Its stock recovered more. Bull case. If geopolitical skies clear and fuel prices drop, Royal Caribbean can continue the strong recovery trajectory it was on. It caters slightly more to higher-end customers who might be more resilient spenders. It reported record revenue per passenger in 2023. With conflict resolved, it can safely deploy ships to lucrative routes, Mediterranean, Holy Land cruises, etc., that might be off limits during war. Additionally, Royal has new ships, e.g., Icon of the Seas, that are driving interest. It's a play on consumers' undiminished appetite for experiences once they feel safe. RCL stock could outperform if travel confidence returns, given it fell less than peers and has. Momentum. Marriott International, the global hotel giant, Marriott, Sheraton, etc. Bull case. Travel rebounding means higher occupancy and room rates at Marriott's thousands of hotels worldwide. Marriott benefits from both leisure and business travel. If, say, Europe is peaceful and Americans and Asians flock back to Paris, London, Rome, Marriott's European hotels fill up at high rates. Furthermore, during periods of stability, Marriott often raises prices and sees record revenues. E.g., summer 2023 was extremely strong for European luxury hotels. Marriott stock did hit all-time highs in July 2023, over $210, but then pulled back to $170s by late 2023 amid war and slowdown fears. It could easily climb back above $200 if those fears ease. As a relatively asset-light model, they mostly manage/franchise hotels. Marriott can quickly translate increased bookings into profit. They're a good broad proxy for global travel health. CNBC.com. Airbnb. Airbnb, although Airbnb can get hurt by war, some hosts in conflict zones disappear, etc., it stands to gain from a travel resurgence, especially from the consumer preference side. Many travelers, post-conflict, might favor alternative accommodations, Airbnb, for more authentic or flexible travel experiences. Airbnb also saw huge demand in Europe in 2023, with record bookings in many cities. If war concerns fade, even more people, including older demographics who are hesitant, may try Airbnb abroad. Airbnb stock, which is fairly volatile, could pop if tourism globally is set to grow strongly. Moreover, Airbnb can benefit if travelers switch away from big hotels, maybe due to cost or desire for privacy. In uncertain times, some choose Airbnbs in less touristy areas. But once safe, those areas flourish with Airbnb stays. So Airbnb is a bull pick with some tech upside as well. It's also branching into experiences, which would gain as tourists return. Alternate bull picks. Expedia, EXP. If travel resumes robustly, Expedia will benefit from more hotel and airfare bookings on its platforms, and its stock is quite depressed, so it has room to rebound on good news. Visa, V, or MasterCard, may. Not tourism companies per se, but they earn fees on travel spending. In fact, both have cited cross-border transaction volumes, driven by tourism, hitting records when travel booms, so they quietly are travel plays too. But that's beyond direct tourism sector tickers. Risk level. Tourism is high risk, similar to airlines. These companies often carry debt, have high fixed costs, cruise ships burn money if not filled, and zero control over demand when shocks happen. We saw nearly every cruise line and many hotel owners on the brink during COVID, needing bailouts or dilutive capital raises. A big geopolitical shock can be nearly as damaging if it really shuts down travel in multiple regions. While diversification helps, a global hotel chain can rely on some markets doing okay if others slump. A truly global scare, like a World War scenario, will be catastrophic to tourism. Even isolated wars create ripple effects, as noted by declines in European tourism sentiment. So yeah, high risk. But with risk comes big swings up and down. The diploma, Insight.com, catalysts. Obvious ones are travel warnings and actual conflict events, e.g., terrorist attacks. Remember how European tourism fell after attacks in Paris 2015, Nice 2016, etc., albeit temporarily. Conversely, peace agreements or ceasefires can be catalysts, e.g., if Saudi and Iran broker some peace in Yemen, tourism in Middle East could improve. More relevant, if Russia-Ukraine reach ceasefire, Eastern European tourism and investor sentiment for travel stocks could improve. Also, consumer confidence indexes often reflect geopolitical concerns. If those improve, it's a sign people may spend on travel again. Forward booking trends reported by companies, like Booking's commentary or airfare/hotel booking data from industry sources, serve as early indicators. Additionally, currency moves. A strong dollar can actually encourage Americans to travel abroad, good for U.S. outbound tourism companies. Though for global tourism, a weaker dollar helps more foreign tourists come to U.S., etc. And like airlines, fuel prices indirectly matter for cruises and air travel cost. Finally, let's consider regional banks, perhaps less obviously tied to geopolitics directly, but they made it into the framework likely due to the notion that instability can lead to financial stress or capital flight that hurts banks. Regional bank sector overview. Regional banks are smaller financial institutions typically focused on traditional lending, mortgages, business loans, in specific regions as opposed to giant global banks. At first glance, one might not connect them to geopolitical risk like war. However, indirect effects can be significant. Wars can cause economic slowdowns, market volatility, and shifts in interest rates, all of which affect banks. Moreover, in severe crises, people often flock to the perceived safety of big banks or government bonds, potentially leaving regional banks in a lurch. Our matrix gave regional banks low bullish bias, high bearish bias, risk high. Indeed, we saw in early 2023, not geopolitically driven but by interest rate risk, how fragile some regionals can be. A few high-profile bank failures, SVB, First Republic, triggered a broader crisis of confidence in regionals. Add geopolitical uncertainty on top, and investors can get very skittish about banks. Bear case. The main geopolitical channel to regional banks is economic and market disruption, credit risk. If a geopolitical event, like a war, harms the economy, either nationally or in certain industries, regional banks could face a rise in loan defaults. For example, if a war causes a spike in oil prices that then triggers a recession, people lose jobs, businesses fail, borrowers will struggle to repay loans. Regional banks often have lots of exposure to commercial real estate, CRE, and small business loans. Those are vulnerable in downturns. We already know many regional banks in 2023 are under scrutiny for CRE loans, especially office buildings losing value. A war-induced economic slump could be the straw that breaks some banks' loan portfolios. Fitch Solutions noted mounting pressure with concerns over lending standards and credit quality centered around CRE at U.S. regionals, with some banks already taking losses. FitchSolutions.com, flight to safety. In any crisis, be it geopolitical or financial, depositors might prefer the perceived safety of megabanks, J.P. Morgan, Bank of America, or U.S. Treasury bonds, or even cash on a mattress, rather than a small bank in their town. We saw this in March 2023. The failure of SVB caused deposit flight from smaller banks to big banks, a form of contagion. If a war rattles markets, people might similarly move deposits, especially uninsured deposits, to the biggest institutions or money market funds, which invest in government securities. That can leave regional banks with a funding squeeze. The risk is high that if one or two regionals show stress, contagion fear could hit many of them, a classic bank run scenario. Key takeaway: persistent headlines drive risk-off behavior, leading to share price declines across multiple regional banks, even those with strong fundamentals, as an analysis observed. Banksandbankers.com, interest rates and bond portfolios. War-driven inflation, e.g., via oil, could force central banks to keep rates higher for longer. Higher interest rates can help banks' net interest income in theory. They charge more on loans. But it also erodes the value of their bond holdings. Many regionals hold lots of treasuries or mortgage bonds. In 2023, those lost value as rates rose, contributing to SVB's collapse. They had to sell bonds at a loss. A renewed inflation spike or volatility in the bond market due to a geopolitical shock could further devalue bank securities portfolios, hitting their capital. Zions Bank, for instance, took a $325 million markdown on its bond portfolio in Q3 2025 due to rate moves, shocking investors and tanking its stock 15% in one day. So, regionals are walking on a knife edge with these unrealized losses. Any factor that changes rate expectations abruptly, like war, can hurt. Conversely, if war causes a recession, interest rates might eventually fall, which could help bond values, but then you have credit losses. Pick your poison. BanksamBankers.com. Cybersecurity. Let's not forget, a lot of nation-state cyber attacks target financial institutions. In a heightened conflict, especially involving, say, Russia or North Korea, banks, including regionals, could be targets of cyber warfare. A successful cyber attack on a mid-sized bank could cause a loss of confidence or direct financial loss. It's a tail risk, but possible. We know North Korea has done bank hacks, like Bangladesh Bank in 2016. Russia has targeted financial networks with malware, e.g., NotPetya affected banks in Ukraine and beyond in 2017. Regional banks likely have weaker cyber defenses than big wall ST banks, making them potentially softer targets. So that is another risk factor due to geopolitics. All told, in a risk-off geopolitical environment, investors will likely dump regional bank stocks out of caution. We saw how sensitive these stocks are. The KBW Regional Bank Index, KRX, is down significantly in 2023 from banking turmoil, ad war jitters, and it could slide more. Fitch in October 2025 noted, 2 high-profile bankruptcies and adverse disclosures triggered a sell-off, spilled across markets globally for regionals, showing how quickly sentiment can sour. FitchSolutions.com. Timeframe. Banking issues can unfold more slowly than something like travel. Deposits might not flee all at once unless a direct panic. But stock prices often move preemptively. In anticipation of potential trouble, investors sell regionals quickly. We saw 30 to 50% stock drops in a week for some banks in March 2023. So expect an almost immediate hit to stock prices when war risk is high, as part of a general flight from risk assets. Actual financials, like credit losses, would materialize over quarters. By then, stocks may have either recovered if war ended or fallen further if recession is confirmed. Bearish tickers. 3 picks, short/avoid Zions Bank Corporation, Zion Y short. Zions is a prominent regional bank based in Utah, operating in western states, that has been under scrutiny. It got hit hard in the March 2023 turmoil, and again in late 2025 after revealing that big bond portfolio loss. It's considered to have notable exposure to commercial real estate and is somewhat rate sensitive. Fitch mentioned Zions as a case of surprise losses impacting sentiment. If geopolitical stress leads to economic stress, Zions could face more credit issues. It's already lost a lot of market cap this year, but in a crisis scenario, one might fear it still has downside. At worst, some speculate on its solvency if losses mount. It's a kind of bellwether for troubled regionals now. So, shorting Zion is a direct play on that pessimism. BanksamBankers.com. Western Alliance Bancorp. WELY short. Western Alliance, a Phoenix-based bank, was one of the banks under attack by short sellers during the regional bank panic, though it survived and later bounced. It's viewed as a bit more aggressive bank, and indeed faced rumors and had to issue strong statements to quell fears. Western Alliance also has meaningful exposure to areas like multifamily real estate and tech startup funding, similar to SVB's community. The Banks and Bankers blog referenced legal claims against WAL regarding risk disclosures, showing it's still somewhat embattled. If another crisis of confidence comes, WL stock could be hammered again, possibly worse than last time if people figure, where there's smoke, there's fire. In other words, it might not get the benefit of doubt twice. BanksamBankers.com. KeyCorp, KY short. KeyCorp is a larger regional, Cleveland-based, but still considered a regional superbank. It's known to have high exposure to commercial loans, including some risky CRE and leveraged loans, and its net interest margin got squeezed in 2023. KeyCorp's stock has been very weak, minus 40% YTD in 2023. In a geopolitically induced downturn, Key could see credit costs spike. It also has a somewhat high loan-to-deposit ratio, meaning it's more reliant on stable deposits. If depositors flee or reprice, ask for higher rates, Key's profits suffer. KeyCorp was one of the names analysts flagged in 2023 as vulnerable. If one is bearish on the regional bank sector, Key is often cited as a short candidate because it's fairly liquid, well-known, and has clear fundamental pressures. It may also cut its dividend if things worsen. It's currently yielding high, which markets often see as unsustainable if stress continues. Others, First Horizon, FHN, a southeastern regional that had a merger with TD fail, possibly vulnerable. Comerica, CMA, ***, heavy on commercial loans in Texas/California, hammered in 2023. PacWest had been won but got acquired by Banc of California after collapsing, so out. Truist Financial, TFC, larger but has been underperforming due to heavy CRE and merger hangover, could drop more in crisis, but TFC is bigger than typical regional size. Smaller community banks might also be at risk, but tickers less known. Bull case. If geopolitical tensions ease and the economy avoids major harm, or even benefits from lower energy prices, etc., regional banks could stabilize or rally. They prefer a scenario where interest rates come down gradually, so their bond losses reduce, and no severe credit crunch happens. Actually, if a war causes the Fed to cut rates, say due to recession fears, that might initially hurt bank margins but improve their bond values and ease funding stress. Additionally, stable geopolitics means more stable markets. The absence of panic allows regionals to retain deposits and continue lending normally. Regional banks could have a slow bull case. Unlike airlines or defense, they don't suddenly skyrocket on peace. Rather, they'd recover as the yield curve normalizes and as investors feel comfortable taking risk again in financials. Possibly consolidation could accelerate. Bigger banks might acquire weaker regionals on the cheap, which could boost stock values. Many trade below book value now, making them potential M&A targets if environment calms. Bullish tickers. 3 picks. Long if stability. Returns PNC Financial. PNC is one of the largest regionals, really almost a national bank now, and is viewed as high quality, with diversified businesses and strong risk management. Bull case. PNC weathered the 2023 turmoil relatively well. If environment improves, PNC can pick up market share from weaker peers. It's also historically an acquirer, had bought BBVA's U.S. operations. It might be in position to scoop up struggling regionals at good prices, turning that into growth. PNC reportedly looked at Silicon Valley Bank's assets, but passed on bidding. But in future, who knows? PNC stock could rise as it's considered a solid franchise, essentially a beneficiary of flight to quality within regionals. Plus, it has a decent dividend and strong capital, which investors appreciate once panic subsides. Fifth Third Bancorp, FITB Fifth Third, based in Ohio, is another fairly strong regional with a heavy Midwestern footprint. Bull case. It has a balanced portfolio with consumer and commercial loans and has managed interest rate risk reasonably, though not immune. If economy remains okay and yields stabilize, Fifth Third can resume steady profits. It's also at a cheap valuation after the sell-off, so lots of upside if confidence returns. FITB notably kept its dividend intact and relatively high, 5% yield now. So in a calmer scenario, income investors might flock to it, pushing price up. Also, Fifth Third doesn't have outsized exposure to things like tech or coastal CRE that some peers did, so it might shine in comparison to U.S. Bancorp. USB US Bancorp is actually a large super regional, the biggest outside the Big Four in the U.S. It's historically considered one of the best-run banks in America, very conservative. Bull case. USB stock fell in 2023's turmoil, even though it's quite strong. It had to absorb an acquisition of MUFG Union Bank, which temporarily hurt some ratios. If the storm passes, USB is likely to rebound, as it's fundamentally sound and well-diversified. It also will benefit from any rotation back into banking stocks by institutional investors who might start with the safer names like USB. And if smaller regionals remain weak, USB could organically gain deposits and customers. Essentially, it's a haven within the sector. So in a mildly positive scenario where fear ebbs, USB should outperform the average regional. USB is borderline big bank, but since it's not international and is often grouped with regionals, we include it. Risk level. Regional banks equals high risk. As evidence, the rapid collapse of several in 2023, the volatility in their stocks, and the factors outside their control, rates, economic cycles. Also, bank stocks carry inherent risk because losses can wipe out equity fast due to leverage. The system is robust overall, but individual names can and did go to zero, as SVB did. So one must be careful. Catalysts, Federal Reserve policy, hugely important. If the Fed signals rate cuts, maybe because war risk pushes them, that could ironically help regionals by boosting bond values and easing funding costs, sending their stocks up unless it's because of a severe recession, which brings credit losses. On the other hand, more rate hikes to fight war-induced inflation would pressure them further. Government/Fed support. If a crisis reemerges, any hint of regulatory support, like expanding deposit guarantees or liquidity facilities, can cause a relief rally in bank stocks. In March 2023, announcements of the Bank Term Funding Program and larger banks depositing money into First Republic temporarily calmed stocks. So watch out for policy responses and any future stress. Earnings reports and guidance. If regionals show that credit quality is holding up and deposit flows are stable, maybe even increasing, that could rebuild confidence. Many regionals in Q3 2023 reported okay results, but cautious outlooks. If that outlook improves, stocks could bounce to M and news. A weak regional being bought at a premium by a stronger bank will lift valuations for peers, as it implies franchise value. Conversely, if a bank fails or is taken over at fire sale price, that hurts peers, like when First Republic's assets were seized and sold to JP Morgan at a low price. It pressured others. Macroeconomic data, strong employment, and consumer spending despite war would mean borrowers are still paying loans, which is good for banks. So ironically, some war-driven data points, like defense spending boosting local economies, might indirectly help certain regions. And obviously, any major escalation or new crisis like a cyber attack on banks, etc., will be a negative catalyst. Conclusion and investment outlook. To wrap up, geopolitical events cast a long shadow over financial markets, but not every sector reacts the same. Here's a quick recap of our analysis. Defense and cybersecurity sectors generally thrive on conflict, seeing increased demand and bullish trading activity like call volume spiking as nations bolster security. They carry high volatility, but fundamentally benefit from higher government and corporate spending when threats are high. Key insight: defense stocks are structural buys, given rising global tensions, but peace talks can cause short-term dips. Cybersecurity is in a secular uptrend due to constant cyber threats. War just turbocharges it, e.g., 80% YoY surge in energy sector ransomware attacks during conflict. Schaefer's Search.com, CNBC.com, RESecurity.com. RESecurity.com. Energy stocks ride the roller coaster of oil prices. They can see windfall gains when conflict threatens supply. Recent Middle East tensions had analysts forecasting oil in the $75 to $85 plus range near term, bolstering oil producers' outlook. Majors like Exxon have shown they can earn record profits in such times. Yet, the landscape can shift quickly. Any resolution or compensating supply can send oil and energy equities back down. It's a trade that requires vigilance. CNBC.com. 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 Airlines and tourism are hardest hit by conflict, as people avoid travel and face higher costs. We saw real examples. An index of airline stocks losing a third of value in a quarter, and tourism in war zones dies completely. History reinforces this. Wars and terror scares correlate with sharp, but usually temporary drops in travel demand. However, These sectors also have the biggest rebound potential if stability returns. Revenge travel can be powerful, as seen post-COVID and after past conflicts when tourists flocked back to previously off-limit destinations. E.g., after the end of the Balkan Wars in the 90s, Croatia's tourism exploded. The key is timing that turning point, which often lags the official end of hostilities a bit as trust rebuilds. CNBC.com, The Diploma, and Site.com, regional banks suffer more subtly from war, mainly through economic channels and shaken investor confidence. They don't gain any direct benefit from conflict, unlike defense, but they can get hurt by second-order effects like recessions or panic depositor behavior. The cautionary tales of 2023's bank failures show that even without a war, this sector had vulnerabilities. Add an external shock, and those cracks can widen. Ensuring liquidity and managing risk will be crucial for them. On the upside, if war leads to earlier rate cuts, banks' bond losses could reverse. A somewhat ironic silver lining if inflation fears subside. In terms of investment strategy, given this framework, one might overweight defense and cybersecurity stocks during rising geopolitical tensions. For example, consider an ETF like ITA, U.S. Aerospace and Defense ETF, or a cyber ETF like HACK. These provide broad exposure. Indeed, defense ETFs have outperformed in conflict periods, and HACK was up 14% in 2025 amid constant cyber threats. CNBC.com. Indexbox.io for energy. A more tactical approach is needed. Possibly use options or commodity ETFs to play oil swings. Some investors buy XLE, Energy Select SPDR, or specific oil stocks when conflict risk is brewing, but be ready to take profits or hedge as soon as diplomatic winds shift or demand destruction looms. Money.usnews.com. Conversely, one might underweight or short travel and leisure stocks at the onset of conflict, using ETFs like Jets for Airlines or PJ, a leisure industry ETF. Then flip to a long position when there are credible signs of conflict resolution. It's risky to catch the bottom, but signs like an uptick in flight searches or hotel bookings, many data sources like Google Trends or TSA travel numbers are available, can tip off a recovery. For regional banks, caution is warranted in any portfolio. Sticking to higher quality names or avoiding the sector entirely during uncertain times might be prudent. If one believes worst-case scenarios, recession, etc., will be averted, there's value to be had. Regional bank valuations are low, and insiders at some banks have been buying shares on the cheap. But it's a long game that requires confidence in the economic outlook. As a hedge, an investor could pair long positions in big stable banks against shorts and weaker regionals during turbulent periods. Visually summarize our discussion. Here's a risk versus bias heat map of the 6 sectors, incorporating recent market conditions and outlook. Sector bias and conflict: key bullish tickers, 3. Key bearish tickers, 3. Recent performance and notable activity: defense. Aerospace and arms, bullish, high. LMT, Lockheed Martin. War boost orders. NOC, Northrop Grumman. Hit record highs on conflict, 5. https://www.schaefersresearch.com/content/news/2025/10/3-defense-stocks-seeing-unusal-post-earnings-activity. GED, General Dynamics, steady beneficiary of budget increases. None major, sector-wide up. Asterisk, peace scenario, take profits on defense leaders. Valuations could pull back 5-10%. 3. https://www.cnbc.com/2025/11/24/Europe-defense-stocks-fall-as--us-ukraine-make-progress-on-piece-plan.html. Asterisk EU defense index plus 20% YDD. Surging on Ukraine war. Before peace talk dip. 3. https://2025/11/24/Europe-defense-stocks-fall-as-us-ukraine-make-progress-on-piece-plan.html. LMT YDD, minus 5%, lagging after 2022 spike. Underperformed YOY5, https://www.schaefersresearch.com/content/news/2025/10/3-defense-stocks-seeing-options-activity. Calls active at $505 strike. 5. https://www.schaefersresearch.com/content/news/2025/10/3-defense-stocks-seeing-on-usual-post-earnings-options-activity. Peace rumors, NOV25, cause 4 to 5% drops in Rainmetal, SOB3. https://20w/cnbc.com/2025/11/204/Europe-defense-stocks-fall-as-dash-us-ukraine-make-progress-on-piece-plan.html. Cybersecurity. Digital security, bullish, high, PNW, Palo Alto, plus 17% YTD 2025 on strong demand. 7. https://www.indexbox.io/blog/palo-alto-surges-172-and-2025-moderate-by-rating. CRWD, CrowdStrike, endpoint security leader, high growth. FT&T, Fortinet, secure networks, poised for uptick. ZS, Zscaler, high valuation, could fall if spending slows. OKTA, Okta, breach prone, loses shine if threats ebb. Sentinel-1, smaller and profitable, volatile. Sector ETF hack plus 14% in 2025. 7. https://www.indexbox.io/blog/palo-alto-networks-stock-surges-172-and-2025-moderate-by-rating. Cyber threats elevated by war. Large cyber firms beating earnings. PNW Rev plus 15% YOY. 7. https://www.indexbox.io/blog/palo-alto-networks-stock-surges-172-and-2025-moderate-by-rating. Ransomware up 80% in energy sector in 2024 amid conflict. 6. https://www.resecurity.com/blog/article/cyber-threats-against-energy-sector-surge-global-tensions-mount. Driving cyber spend. Energy. Oil and gas. Mixed, medium. ExxonMobil. Up 9% YTD 2025. Huge cash from $85 plus oil. Chevron. Similar tailwinds. 2022 profit record. COP. ConocoPhillips. Pure play oil. High leverage to price. BP PLC. Sensitive to oil swings. EU windfall tax as a risk. Halliburton. Oil field SVCs. Capex cut if oil falls. SLB. Schlumberger. Same as Hal. Relying on sustained drilling. Brent crude volatile. Spiked to $95 September 23, now $80 on mixed war signals. https://www.cnbc.com/2024/08/260/080/26/oil-elevated-as-middle-east-tensions-threaten-a-wider-conflict at HTML. Euronat gas less than $35 per megawatt hour, an 18-month low. On Ukraine peace prospects. 3. https://www.cnbc.com/2025/11/246-Europe-defense-stocks-fall-as-dash-us-ukraine-make-progress-on-piece-plan.html. 3. https://www.cnbc.com/2025/11/ 24/Europe defense stocks fall as us Ukraine make progress on peace plan.html. ExxonMobil and Chevron shares plus 80% and plus 50% in 2022. Ukraine war. Then flat in 2023. Airlines. Air travel, bearish, high Delta. Best in class. Rebounds when travel resumes. Love, Southwest. Domestic focus, fuel hedges cushion impact. ALK, Alaska Air. Also mostly domestic. Less geopolitical exposure to AL, American. Heavy debt, global routes. Minus 30% in 3M. HTTP UCNBC first options trade. That Pacific hotel stock start to feel a travel slowdown like Carolina HTML. UAL, United. Most international. Index minus 33% late, 23 to. HTTP UCNBC flash verse options trade. That Pacific hotel stock start to feel a travel slowdown like Carolina HTML. JBLU JetBlue. Smaller. High fuel cost impact. Multi-year low stock. Airline index XAL minus 30% August. October 2023 to. HTTPS UCNBC options trade. That Pacific hotel stock start to feel a travel slowdown like Carolina HTML. Hamas war plus $90 oil. November 2023. Airline stocks have lost 1/3 of value in 3 months. 2. HTTPS UCNBC flash verse options trade. That Pacific hotel stock start to feel a travel slowdown like Carolina HTML.